Here's a scenario. You wake up, check the news, and see the market is down 30%. Most people panic and sell, but one investor managed to make millions in the same situation. What if keeping calm could actually grow your wealth? In this video, we'll unpack how the right mindset can turn even the worst downturns into opportunities. We'll break it down into three parts: the emotional test, the strategic response, and the long-term reward. If you want proven mental frameworks for navigating market crashes, hit subscribe now. Investing during a downturn isn't just about numbers, it's about handling the emotional roller coaster that comes with uncertainty. The emotional test: why fear can be your biggest investment enemy. Let's look at what really happens when fear takes over during a market crash. This part, the emotional test, is where most investors stumble. When stocks tank and the news cycle is full of doom, it's easy to feel overwhelmed. Many people see their balances drop and almost automatically think about selling to stop the bleeding. That urge to act, even if it means locking in losses, is a natural reaction to uncertainty. But history shows that these snap decisions are often costly. Consider how powerful fear can be in shaping our choices. When markets fall, the discomfort of watching your portfolio shrink can push you to do anything to regain a sense of control. Selling feels like taking action, but it often means selling at the worst possible time. Most investors behave this way, and research consistently finds that people who panic sell during downturns tend to miss out on the recovery. Instead of waiting for things to bounce back, they accept losses that could have been temporary. Let's put a face to this pattern. Lisa was a mid-level professional who'd built up a decent retirement fund by 2008. When the financial crisis hit, her portfolio dropped by more than 40%. She couldn't stomach the losses, so she sold almost everything at the bottom. At the time, it felt like the only way to avoid losing it all. But a few years later, the market had not only recovered, but reached new highs. Lisa's losses became permanent because she let fear make the call. Stories like hers are common, and they show how emotional reactions, not just market moves, can shape your financial future. So why does this happen? Psychologists call this loss aversion. Losses sting more than equivalent gains feel good. That's why the thought of losing money can override logic and long-term planning. When fear is in control, it's hard to remember your bigger goals. Your mind zooms in on the pain of the moment, and it's easy to forget that downturns are a normal part of investing. This is why emotional discipline matters so much. It's not about ignoring fear or pretending it doesn't exist. It's about noticing those feelings and choosing not to act on impulse. Investors who come out ahead during recessions aren't fearless. They're just better at pausing and sticking to their plan when everyone else is panicking. That pause is what separates those who thrive from those who regret their decisions later. Have you ever felt tempted to sell at the bottom? Think about what triggered that feeling and hold on to that thought as we move into the next part, because the real difference comes down to how you respond when the pressure is on. In the next section, we'll look at what happens when someone faces the same fear but chooses a different path. The strategic response: lessons from a recession-proof investor. It's easy to feel overwhelmed in the middle of a crisis, but some investors manage to keep their cool and make decisions that set them up for future success. The strategic response is about what separates those who panic from those who stay resilient. Let's look at Mark, an investor who faced the 2008 financial crisis with a different mindset. While the news was filled with dire predictions and most people were selling off their investments, Mark didn't react impulsively. He had already set up a clear investment strategy focused on his long-term goals. This plan wasn't just for the good times, it included steps for handling downturns too. When the market started to unravel, Mark didn't rush to sell. Instead, he relied on his plan and took a disciplined approach, even as friends and headlines urged him to get out while you still can. What set Mark apart was how he handled moments of fear. He used a three-step mental framework to guide his decisions. First, he paused before reacting, giving himself space to recognize if fear was driving his thoughts. Second, he refocused on his long-term goals, reminding himself that he was investing for decades, not just for the next few months. Third, he cross-checked each move against his plan, asking whether his actions matched his strategy. Please like and subscribe if you like the videos, and share with your friends and colleagues. This process helped him avoid emotional decisions and stick to what he knew worked. Mark's plan was built on fundamentals and diversification, spreading his investments across different sectors. This approach helped him stay resilient even as some areas of the market dropped more than others. By not putting all his money in one place, he reduced the risk of any single downturn wiping out his entire portfolio. Diversification is a key part of any strong investment strategy, and it gave Mark the confidence to stay the course. Discipline was Mark's real advantage. He didn't try to predict every market move or chase quick profits. Instead, he focused on sticking with his plan, even when it felt uncomfortable. Research shows that investors who follow a consistent strategy and avoid emotional decisions tend to do better over time than those who react to every headline. Mark's steady approach helped him ignore the noise and keep his eyes on the bigger picture. These questions didn't just keep Mark calm, they turned fear into opportunity. While others were selling in a panic, Mark started looking for undervalued investments. He saw that many strong companies were trading at low prices, not because they were suddenly bad businesses, but because the whole market was caught up in fear. Mark took advantage by buying shares at a discount, trusting that these companies would recover when the panic. This is the core of a strategic response. It's not about being fearless or having secret market knowledge. It's about having a plan, sticking to it, and using moments of uncertainty to make thoughtful decisions. Mark's approach shows how discipline and a clear strategy can help you weather even the worst downturns and sometimes come out even stronger. The real impact of Mark's choices became clear in the years that followed. The long-term reward, turning crashes into gold. Staying disciplined in the middle of a financial crisis takes more than just a solid investment plan. It takes a mindset that can withstand months of bad news and uncertainty. Mark's approach during the 2008 downturn is a clear example of how the right attitude can turn short-term chaos into long-term opportunity. He didn't focus on the daily swings or let headlines dictate his moves. Instead, he kept his eyes on the bigger picture and trusted that the market would eventually recover. The main topic here is the long-term reward that comes from turning crashes into gold. Mark's discipline paid off over the next several years. The assets he picked up when prices were low steadily gained value as the economy bounced back. Some of his investments more than doubled or tripled as confidence returned to the markets. He didn't try to guess the exact bottom or time every move perfectly. Instead, his edge was sticking to his plan and keeping his emotions in check, even when it felt like everything was working against him. It's important to remember that staying invested during a downturn is emotionally tough. Watching your portfolio shrink, sometimes for months on end, can make you question every decision. Mark faced moments of doubt just like anyone would. He wondered if he was making a mistake, especially when it seemed like the bad news would never end. These feelings are normal, and they're a big part of what makes investing through a crash so challenging. But Mark's story shows that enduring those tough stretches can lead to some of the biggest payoffs. Historically, major indices have rebounded and gone on to reach new highs over the years following recessions. Investors who stayed the course during the 2008 crash, for example, saw their portfolios recover and then grow far beyond their pre-crisis levels. A modest investment held through the downturn could have more than quadrupled over the next decade. In contrast, those who sold at the bottom and waited on the sidelines often missed out on the strongest part of the recovery. This gap in outcomes highlights just how costly it can be to let fear drive your decisions. Part of the reason for this difference is the power of compounding. Recovering from a big drop takes disproportionately larger gains, but by staying invested, you let compounding work for you rather than fighting it. Each rebound builds on the last, and over time, those gains can transform even a battered portfolio into something far more valuable than if you tried to jump in and out of the market. Mark's experience is a reminder that treating downturns as opportunities instead of disasters can change your financial path in a big way. It's not easy to watch your investments fall in value, and it's natural to feel anxious or even scared. But the biggest rewards often come to those who can manage those emotions and stick to their strategy. People who let fear take over tend to look back with regret, realizing too late that the real opportunity was in staying patient. So when you think about the next market downturn, ask yourself, are you ready to hold steady when things get rough? The real reward comes to those who can keep their mindset strong and see beyond the panic. That's what sets successful investors apart and lays the groundwork for long-term growth. Understanding this mindset is just the beginning. Conclusion: thriving in tough markets isn't about making perfect predictions, it's about managing your mindset and sticking to your plan. The best investors don't let fear drive their decisions. They rely on discipline even when things feel uncertain. Will you let fear decide your next move, or will you stick to your plan and seize the next downturn as a buying opportunity? Take a moment to share in the comments how you handle market volatility. Your experience might help someone else in this community. If you found this mindset shift helpful, subscribe and hit the bell so you won't miss our next strategy breakdowns.